Good morning, traders and investors. My name is Roger Scott, and I'm the Senior Strategist for WealthPress. Today's Thursday. It's October 27th. It's only 2 days before my 52nd birthday. Don't get me started. It's about 8:10 in the morning, and the market's going to open up in about an hour and 20 minutes to be specific with you. Now, folks, if you like these videos, please subscribe to this channel, like this YouTube channel, and post comments below this channel so I can answer them and others can read them for your benefit. Or I could use that question for my videos. People love getting these answers. So don't think if you're the only one who's asking it, you're the only one who's interested. A lot of people ask similar questions. Now, let's get into today's analysis. As you can see here, the Dow Jones is up about 200 points, give or take, but the NASDAQ is down. Why? Earnings on tech stock. Google yesterday, Microsoft yesterday didn't do so well. Matter of fact, if you look at Microsoft right now, it's still down a little bit, although I think we're going to have a little turnaround. And Google, same thing. I think we're going to have a little turnaround. I'm smelling a little turnaround here. Today's a big day. I mean, huge day. Why? Well, I thought you'd ask. Well, we've got earnings on Amazon. They're expecting 29% less year over year on their EPS, 22 cents per share. That's awful. That's really awful. And Apple expecting just barely trying to squeak by here, okay? But look at all the other companies you've got, and I mean all over the place. We're becoming very broad now in terms of our earnings, and I should have an update for you later today or early tomorrow. I wanted to wait for this week to get a couple of hundred earnings so I can give us a really good estimate of where the S&P is going, which sectors are outperforming, which sectors are underperforming. But as you could see here, today is the day where we're getting a lot. Comcast, Capital One, Caterpillar, BorgWarner, AutoNation, Areas Management, Anheuser-Busch, AMT, one of my favorite stocks, MO, Altria, Philip Morris, Decker, I love the stock, First Solar. I mean, you name it, it's coming out. Keurig Dr. Pepper is coming out. MasterCard is coming out. A lot of companies. McDonald's. Northrop Grumman's coming out. This company should do really well. Defensive stocks are doing well. You got Royal Caribbean, so I wouldn't be putting my bet on that sinking ship. Shopify's coming out. Could be something good if Amazon rocks. That's they're right behind each other. South Airlines, Southern. I mean, everywhere I look, you've got like big companies. U.S. Steel, VeriSign. I mean, this is big day. That's one of the reasons why we're having such a mixed market. Aside from all of these earnings, I mean, this is a very difficult time to time the market because you've got so many different things being thrown at it from so many different perspectives. Tech earnings, blue chip earnings, and then, oh boy, durable good orders coming out in about 17 minutes. New orders, they're expecting positive numbers. Honestly, I'm going to be honest with you. Anything positive, new orders would be great. I'd love to see positive new numbers. It would be great if it was above 0.6. Capital good orders, I want to see positive numbers. But that's not going to be the biggest report. The biggest report is going to be the GDP. And they're expecting a positive growth of 2.3 and personal consumption of 0.8. If the 2.3 is a little down, but the personal consumption is a little higher, that will go a long ways. Because remember, this is going to tell the Fed if the economy is starting to hum again or not. So I'm hoping that this number is better than expected. And if the personal consumption expenditure number on the annual rate is 0.8 or higher, I'm hoping it's 1%. That would go a long ways to show stability that consumers are still spending. So this is going to be coming out probably before you get this report. But again, here are the numbers. 2.3% is the expectation and 0.8% on expenditures. And if the quarter over quarter annual rate is a little low, but expenditures is good, it can offset it and vice versa. And then again, you have durable goods, and that's coming out in 16 minutes. You want to be prepared for that. And again, keep your eye on the market before the open. Bond market should be the biggest, should reflect this the most. It's starting to be down a little bit. And if this is it for this rally, then this market is going to cool off in terms of the individual stocks too, which is one of the reasons we shorted SIX, we shorted MAR, we shorted GE. I think a lot of these stocks are going to be going down, especially hotel stocks, hospitality stocks. I think the market may be not loving them as much as they did a year ago. Volatility still appears to have been peaked out, and we are well below the 28 level. I'm hoping that this level will continue going lower. It's not being impacted too much by the tech because it's being offset by positive numbers from the U.S. stock market in terms of the Dow Jones. If this number continues breaking, the next level is 2578. And I think if today we can break lower, we're going to get some relief. But again, we may see some bumps along the way in the road. Overall, I think bond markets are choppy. I don't know if they're ready to go all the way down or not, but the next few days are going to be very, very instrumental. What I'd like to see is a trading action like this, because this will put more stability into the stock market. Let's talk a little bit about global economy, and this will kind of cement what we've been talking about here. European central banks meet as expected to raise its key interest rates to a 13-year high to fight stubborn inflation. One of the upsides we have seen is U.S. stocks in the morning have not been roiled by global economy over the past few weeks, which has been very, 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 very positive. Forecasters expect the U.S. government data to show that the economy grew in the 3 months ending in September, following 2 quarters of contraction. Other indicators, including housing sales, suggest activity is cooling following rate hikes to rein in a 40-year high inflation. The ECB, which manages the euro currency used by Germany, France, and 17 other countries, is expected to raise its benchmark to 0.75. They're mimicking what we're doing in the U.S. and hoping that it's going to work. On Wednesday, we had earnings from Microsoft and Google. They were not as good as expected, which is one of the reasons why we saw the tech fall while blue chips actually rose, which is interesting because we haven't had big divergence between individual sectors so much this year, as much as we should have actually. Shrinking bond yield suggests investors believe that the Federal Reserve might ease up on its rate hike plans as early as this year. I actually think they're going to do this last rate hike, and then they're gonna see and wait maybe a month or two to see how things have gone. But I think this is the last 0.75, and if that's the case, that would be very, very positive. On Thursday, investors will look for signs that the U.S. economy slowdown is finishing or starting up even more when the government releases its first estimate of third quarter GDP. That's coming out in 13 minutes. The Fed is expected to raise its lending rate by another 0.75 of a percentage point at its November meeting, but traders have grown more confident it'll cut back to 0.5 in December, according to the bond yield right now. And I'm seeing the same thing. I think they're going to just pause and see, or they're going to go to 0.50, which would be very, very, very good. As I mentioned, volatility is still stable and it's still moving lower towards the 200-day moving average, which is at 26-ish level. Put to call ratio still very, very highly inflated, still favoring the puts. But with that said, it looks like we're bouncing higher and we still couldn't break this level, which means there's a hell of a lot more put buyers than call buyers right now. In terms of momentum levels, you don't have all that many stocks trading higher, and you don't have a lot of stocks trading lower. So instead of seeing a lot of directional movement, we may end up just seeing non-directional volatility. Or here's what I'm expecting to happen. I think if the GDP is solid, I think we're going to see a turnaround in QQQ today, because I think Apple and Amazon are going to be slightly better than expected, and I think the majority of the mishigas and all the garbage is priced into the NASDAQ. So I think today, or maybe tomorrow, we're going to start going higher on the NASDAQ because it seems to be that the broad market, if you look at the Dow, still seems to have some upside left in it. Let me just show you a different type of chart. So as you can see here, momentum levels on the Dow are still pretty good. We haven't hit the 200-day moving average. I would be cautious if we hit the 200-day moving average, which is what I expected after this run-up, but we haven't seen that yet. Again, to me, this still looks like a bearish trend, a bearish long-term trend, and a short-term bullish trend against the trend. I would need to see the stock market trade above the Dow trade above the 33,400 level for me to think that this is something more than that, okay? If you're looking at individual stocks, I'm going to tell you right now, let me make your life really easy for you, okay? Energy, healthcare, industrial, financial. And on the bottom, real estate, communication, utilities, and technology. Be careful shorting utilities. This is an oversold sector, and I think it's overreacting, and I think it may start moving up because it's very uncharacteristic for utilities to be in between technology and communication services. That just tells you once again how fragmented this damn market is. It's just too much. But in terms of stocks that are looking good, I want to show you guys something here. If you look at the S&P 500, you will see that we still have energy, consumer staples, healthcare. Most of these stocks are still in a strong trend. And from where I'm sitting, I'm not seeing a peak in the energy. Look at natural gas. We're having a shortage right now. APA, I've been talking about the stock all year. But healthcare, energy stocks, basic materials like Albemarle, again, that's where the money is right now. A few stocks that are consumer discretionary are popping up, like Genuine Auto Parts, AutoZone, but for the most part, Netflix, which I think is overdone, and I think that company is not moving in the right direction. But as you can see here, the majority of the upside is in the defensive stocks, and I think it's going to remain there for quite some time. Keep your eye today on Apple. Big. Keep your eye on Apple. Very, very important. Because if this thing starts coming off, that's it. The rally in tech is over. And Amazon. And to me, I believe they're either both going to be moving higher or both going to be moving lower. Right now, they both look like we're going to start a little downtrend right now. And if you look at the QQQ, we're getting a little overbought. So we got to be really, really careful right here because volatility may be rising in tech stocks if those numbers are not so good. And again, we'll have to see how they are. But I think tech is beginning to price in most of its downside. Again, the GDP and durable goods is going to determine a lot today, especially in the morning. Towards the second half of the day, towards the first half of the day, keep your eye on the bond market and blue chip stocks. Towards the second half of the day, keep your eye, especially towards the close, keep your eye on how Amazon and Apple are doing. They will give us a big picture. If they start rallying towards the end of the day, that means tomorrow will probably be a really good day. If they start breaking down towards the end of the day, oy. But we got to be very, very careful because we've got a combination of lots of stuff. Now, folks, we had something big happen yesterday. And I want to thank everyone for showing up to my class, for my quantum indicator class. It was awesome. And folks, if you missed it, I urge you to click the link below to watch the replay right now. You'll get all the details of my brand new trading tool. In the class, I cover how the indicator has shown the power to pick up on market moves with a high historic probability, why the indicator targets stocks that have fallen so deep into oversold territory that their next logical choice is to revert higher in the days ahead, the steps to take to install the quantum indicator in your own platform, and make sure to stay up till the end for a very, very special surprise. Click the link below to watch it right now. There's a link below the YouTube channel if you're watching on the YouTube Wealth Press channel, or you could just watch it on our page below this video. Remember, comment, and remember, it's going to be a very volatile market. There's too many things being thrown. Apple, Amazon, GDP. I mean, what's next, right? And the bond market. So keep your eye on it. Bond market, I want to see go higher, and I want to see a reversion of text towards the end of the day. Bye, guys. Remember, comment below this video, and I'll respond to you. I want to hear from you and stay in touch with you. Bye, guys. Take care. Have a great Thursday.